Ladies and gentlemen, good day and welcome to the Hindustan Foods Limited Q4 FY22 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Samit Kothari, Managing Director. Thank you, and over to you, sir.
Thank you, Rutuja, and good afternoon and welcome everyone for our Quarter 4 FY22 and financial year ending March 31st, 22 earnings conference call. I hope each of you and your families continue to remain safe and healthy. I'm joined on the call by Ganesh Argekar, who's our Executive Director, Mayank Samdani, who's our Group CFO, Vicky Solanki, who's the Head Emerging Businesses and Corporate Communications, and Bankim, who's our Company Secretary. I'm also accompanied by SGA, our Investor Relations Advisors. I hope everyone has had the chance to go through our updated investor presentation, which was uploaded on the exchange and also on our company website. Coming to the performance of the company, I have to say that I'm pleased with the performance in the last quarter and also for the entire financial year. What gives me confidence is that in spite of all the headwinds, including commodity inflation, slowing demand, stress in rural demand, etc., we've been able to achieve the target that we had set for ourselves, which was that of achieving a turnover of 2,000 crores. As I had mentioned in my earlier call, our business model not only shields us from the short-term vagaries of demand and inflationary pressures, but also provides us with a clear visibility of the medium term in terms of our performance. Which brings me to our future target. In my last call, I had laid down the path for reaching our next goal of 4,000 crores. And I can confidently say that we are on track for most of those things that we discussed earlier. The M&A transactions have progressed, factories have been integrated into our systems, and some of these factories have actually gone ahead and achieved their highest ever turnovers in the last quarter and in this month of April as well. But more importantly, we've been able to continue servicing our customers from all of these factories without any disruption. The deal pipeline looks strong, and in spite of the general slowdown in the FMCG volumes, our strategy to diversify across product categories is beginning to pay off. To illustrate, while some of the categories are facing volume headwinds and down trading, some other categories like ice creams, beverages, color cosmetics are seeing a major spike due to the pent-up demand of the last couple of years. We continue to invest in CapEx across various geographies and are confident that things are beginning to sink in. We have successfully in the last few years changed HFL from a single product, single location, single customer company to one of the most diversified FMCG contract manufacturer in the country. This has been achieved by building new factories, identifying agencies and integrating acquisitions, and developing new customers and product categories. I'm confident that this experience will hold us in good stead as we start our journey from 2,000 to 4,000. I will now hand over the call to Ganesh, our Executive Director, who will brief you on the operational highlights.
Good afternoon, everyone. I would like to highlight the operational performance of Quarter 4 and Financial Year 22. All the existing units of the company were stable and performed as per expectations. Our new color cosmetic acquisitions were completely integrated, and the factory achieved its highest ever turnover in the month of March 22 and again in the month of April 22. The ice cream plant in Lucknow, UP, commenced trial production and the first dispatch was made in April. We expect it to ramp up production to approximately 15,000 liters by the end of 23. We need to invest in additional 75 crores at Lucknow for the expansion of ice cream plant. We expect the increased production to start from Quarter 4 23. The merger of ATC Beverages is completed and the expansion at Mysuru has been commercialized. The unit has started manufacturing for Tata Consumer Products Limited in addition to the existing customer Hector Beverages. We are hoping to invest to double the capacity of this site. The soaps and bars project in Hyderabad continues to be delayed, and we are cautiously optimistic to start project work in June. The new factories for the footwear division, sports as well as knitted shoes have been commercialized, and both the units in Tindevanam, Tamil Nadu and Vasai have started production. I will now hand over the call to Mahek Samdani, our Group CFO, to take you through the financial results of the quarter and financial year 21-22 and explain to you the thought process of our decision to split the shares. Over to you, Mahek. Thank you.
Good afternoon, everybody. I will like to highlight the financial performance for Q4 and FY22. We are very happy to share that we have achieved our target of 2,000 crore of revenue for FY22, which is 45% growth over last year. Our total revenue for the quarter increased by 15% on year-on-year basis to rupees 563 crores in Q1 FY22 as compared to 491 crores in Q4 FY21. EBITDA of FY22 stood at 120 crores, which is higher by about 30% on year-on-year basis. While the PBT was higher by 41%, the PAT growth of year-to-year for the financial year was not strictly comparable to the last year, as the last year PAT includes certain one-time tax adjustment, and excluding that, the PAT growth was 41% as well. As can be seen, all the three parameters, revenues, EBITDA and the profits, are the highest in the history of the company. As far as our ratios are concerned, as the shares of the dedicated manufacturer increases, our margin profiles are tending to our normal rates of around 5.5 to 6.5% EBITDA and around 2 to 3% of PAT. This is in line with our expectation and guidance. Our ROC and ROE have improved as most of the capex are productive. While I am confident that we should be able to better this, as some part of the capex continues to be work in progress, given our track record, I can be confidently say that we will always have some capex proposal as work in progress. It is this continued investment of capex finance from our internal accruals and debt that have led to the significant gross block of around 550 crores on the consolidated basis, including capital WIP, leading to the scalable performance, prompting a rating upgrade from India Ratings. Considering the size and ambition of the company, the board has considered a split of the equity shares of the company from the face value of 10 to the face value of 2 each. We reiterate our near-term and long-term targets for revenues and profitability as we continue to focus on accelerating growth through exploring organic and inorganic opportunities. With this, we also remain focused on strengthening our balance sheet and cash flow through effective working capital management, which would facilitate us for further growth. With this, I would like to open floor for the questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Faisal Hawa from SG Hawa and Company. Please go ahead.
Yeah, hi. From your investor presentation, I can see that the cash flow from operations has gone down quite a bit from the last time, in spite of our revenue being much higher. So, can you give me some reasons for that, and is there some steps that we have taken to improve it? Second is that with these inflationary pressures, are we, kind of facing some kind of, requests or, from top management of your main clients that, postpone the cost increase for this quarter or for this month, or, just to make their balance sheets or profit and loss look good? That's second. And third, since the new developments person is also on the call, can he guide us as to how he's approaching new business for HFL?
Hi, Faisal. This is Sameer. The first two questions are about the financial performance. I'm going to ask Mayank to talk about it. And as far as the new development is concerned, I'm going to ask Vicky to talk about it.
Hi, Faisal. This is Mayank here. As you are aware that we have invested in our subsidiaries. One is the HFL consumer product, which has ice cream plant, which is commercialized in April, and AeroCare, which is LLP, which we have taken over from in January. Both those investments which we have done in tune of around 45 to 50 crores is being treated as current investment, not as the loans. So as a result, that all these investment has gone in the operational cash flow and not in the financing activity. That is why these 45 to 50 crores is in the operational cash flow in the negative items.
So what would be the advantage in doing that?
Yeah, so just to elaborate on that, Faisal, the auditors have decided that since the investment has not been made into the fixed capital in case of the LLP and not in the share capital in case of the subsidiary, since they are being shown as loans, they have treated that as a current loan or a current advance which they can recall at any point of time. And as a result, they have classified it as part of our working capital and not as a part of our investing cash flow.
So these subsidiaries would be carrying that 15% income tax, right?
So one of them will. The HFL consumer is the one which will be carrying the 15% income tax rate, like you rightly identified. AeroCare, as you will recollect, was an acquisition. It's an older company which was in existence even before the new tax law of that 15% was announced. So unfortunately, in case of AeroCare, we will be continuing to be at the highest tax rate.
So AeroCare, like we have acquired it around, I think, 30 crores this thing, and you are expecting 100 crores sales. So I mean, this is like a good acquisition, almost like at 0.3 times sales. So I mean, do you see such future acquisitions also coming up with a lot of such contracting units on sale and not wanting to continue the business on a standalone basis?
So, Faisal, thank you. I mean, we all are very confident about the AeroCare acquisition, and yes, we all believe that it was a good acquisition. In terms of the future, I obviously can't give you any specifics, but given all that's happening in the market, and you talked about inflation and you talked about the customers pushing back, etc., we strongly believe that we will get more opportunities like this, because in case of a difficult environment to work, smaller and unorganized contract manufacturers will probably find it difficult, and we are hoping that we should be able to take their place and expand.
And what is our current ROC and ROE? 22 ended?
Our current ROC is around 20%, Faisal, and current ROE is 19%.
You said 20%?
Yeah.
Okay. Yeah, that's it from me, for at least on the financial side.
Thank you.
Yeah, hi Faisal. Just to answer your last question on the new products, on the emerging businesses, like when we work with most MNCs operating out of the domestic market as well as the domestic companies, there are a bunch of companies which we hope to kind of get them into our baskets sooner than later. We trying to work with them for existing categories, new categories, and of course there are a bunch of startups, retail chains which are growing. We continue to talk to them. We have a few, and we try to get the rest into our portfolios. We continue talking about current categories with our clients. We talk about new extensions of the current categories. We are sprucing up our R&D so that we are able to match up to their requirements of new products and a few other things. Yeah.
So how are your KRAs built in? I mean, how much of of new revenue that you have to get in every year? Because what is happening is the existing pie is also growing, and then you have to get in new business also. So how do you measure that?
So Pedro, it's a good problem to have now if the existing business is growing and we have to get new businesses.
But I want to know that how this KRA is building.
Sorry?
I want to know how this the particular assignment is the KRAs of this post are built in.
So I understand where your question is going. So let me just talk to you at a macro level. What we've done with the business development team is we have 4 verticals. We have one gentleman and one team who heads the key accounts. These guys basically look after our existing customers, large MNCs, and we try and see how we can increase our wallet share with these guys. We've got another lady who heads the new accounts as well as private label development for home and personal care. And then we have Vicky, who's basically heading our food related new accounts as well as new product development. Then we have another sales and business development person who's basically looking after the health and pharma initiative that we've just started. All the 4 of them have very clear-cut targets in terms of which customers they're supposed to go after and what is expected from those customers.
Okay.
Yeah.
I'll join back in the queue for the more questions.
Thank you. Ladies and gentlemen who wishes to ask a question may press star and 1 now. The next question is from the line of Akash Zaveri from Perpetual Investment Advisors. Please go ahead.
Hi Samir, thank you for the opportunity and congratulations on a great set of numbers. My first question, just would like to touch upon the ATC nerve that we still have a loss in ATC and it's about more than 80 lakhs and this will be I think just until February 17th. So isn't that very steep even year on year if we see the loss is widened, it's more than doubled. So if you could just throw some light on that.
Sure. So Akash, ATC was the millstone around our neck for the last couple of years, as I've talked in a bunch of investor calls as well. I'm happy to say that, and it's not just my information, but you'll be reading it in all the pink dailies, that beverage consumption and out-of-home consumption for beverages has increased tremendously in this year. So I'm happy to that the same exuberance in demand is reflecting in ATC's performance as well. We've had the highest turnover in March and then again in April. What we've done is we've also been able to successfully convert 2 of our customers there. One who is a new sign-on, which is Tata Consumer, and the earlier one, which is Hector Beverages. Both of them have now signed up with us. And if you're familiar with the business model of the company, ATC is now not a shared facility, but it's an anchor tenant facility where both Hector and Tata Consumer have given us commitments in terms of their total offtake for the next financial year, which is FY23. In addition to that, we are cautiously optimistic about the performance of beverages going ahead. And the board has actually sanctioned us some money to expand the capacity at ATC. So yes, you're right that the performance of ATC has not been very good so far, but we are quite confident that it should turn around completely in the next a few months.
So we can expect to see some profit from Q1, and would the profits from Q4 and Q1 kind of cover the costs for the rest of the year?
Okay, you have to explain that to me. So will we start seeing profits from Q1? We certainly hope so.
Okay.
I didn't understand the second part of the question.
The second part was generally for beverages, Q4 and Q1 would be, the best quarters. So would our profits in these 2 quarters, assuming that Q2 and Q3 would see some softening in demand for beverages, would the profits in Q1 and Q4 be enough to, on a whole year basis, would ATC be profitable? Like that's the kind of question I'm asking.
Apologies, I didn't understand the question. So you're absolutely right. In case of beverage industry, that's generally the trend. In case of ATC, we've got 2 things which are in our favor. One is it's located in Mysuru in the south, where the seasonality and the off-seasonality of beverages is not as distinct as, let's say, the northern territories. So as a result, in case of South, since the weather does not really become cold in the winters, beverages sales do not come to a complete halt in ATC, as opposed to, let's say, the unit was located in the north. The second thing, as I mentioned in the first part of my conversation on ATC, we've been able to successfully transition both Tata as well as Hector Beverages to an anchor tenant of that facility, which means they have given us commitments for the entire year. And as a result, I think we've been able to remove the variability and the seasonality of that factory to a certain extent.
Got it. My next question would be, how much would be the impact of power and fuel costs, and do we get to even pass on this with a lag?
In case of the dedicated manufacturing and the anchor tenant model, we get to pass on the entire power and fuel cost increase to our customers. In case of shared manufacturing, there would be a lag. And in case of private label, we would probably not be able to pass on that increased cost.
Okay, got it. My next question would be with regards to the UP plant. So how much would the 125 crore investment yield in terms of top line, and the additional 75 crores that we just announced? Am I right on thinking that this would double the capacity?
Okay, so let me just step back to that one question on the power, and I'm going to come back to this question as well. So while I mentioned about, I know that you are familiar with our business models, maybe a lot of the participants in the call may not be familiar with it. So when I said dedicated manufacturing, you know that nearly 80-85% of the company's turnover comes from dedicated manufacturing. And by definition, all inflationary costs can be transferred to the customer in case of the dedicated manufacturing. So frankly, whether it's power, fuel, whether it's commodity prices, etc., we can pass that on to the customers. Now, coming to the second part, since HFL Consumer is a single product company right now, I'm not at a liberty to discuss the turnover. You'll obviously see it in a couple of quarters. But I can confidently confirm that the asset turnover ratio for this factory should be similar, which is around 3.
Got it. Okay. And so the next question would be, are the payments for the Social acquisition completed?
Mayank can answer this question. No.
So Akash, as you are aware that we have signed the share purchase agreement in Jan. There are some legal and legal things to be done before, and approvals to be taken, which is in process. We hope that we will be able to close it this quarter. By June, we are hoping that we will close the transaction totally.
Okay, got it. The next one would be...
So payment will happen only once the approvals from the government authorities come for this transfer.
Correct. So we expect that in Q1.
Yeah.
Okay. And are there any price hikes which are expected to be passed on in the rest of the business, which took a toll on margins, or have the price increases been completely passed on?
So Akash, in our case, like I said earlier, the business model is such that price hikes are automatic. So every time there's a change in the commodity prices, or if there is a change in the power cost, or for that matter, even if there is a minimum wage increase, it gets passed on automatically. Like we mentioned in previous calls, while there might be a lag, that lag is more of an accounting phenomena rather than a commercial phenomena. What I mean by that is we will recover the money, but it could come in a quarter lag or something like that. But we do not foresee any situation where our margins should get affected because of inflationary pressure.
Yeah, I completely understand that. That question is more of like, has a lag happened, or do we still see that lag? So I completely understand that. So the next question would be, how do we plan to fund the capex of the 345 crores which we've announced and that's remaining in terms of cash? How do we plan to fund it?
I was looking at Mayank because I thought Mayank would take that question, but he's deferred it to me. So, Akash, we do not have any intentions right now to look at equity. We continue to think that all the capexes which have been announced we should be able to fund it through debt and internal accruals.
Okay. And currently, if you could just quantify what would be the total tax loss that we have at ATC?
The total tax loss of ATC is around 19 crores, which we will be able to utilize in this year.
Okay. And also another question would be that the accumulated MAT credit that we have, how long before we use those credits and go to the 25% tax regime?
So this is a chicken and egg question, Akash, because we continue to invest in new factories. The MAT will continuously increase, That the only time when we get the utilized MAT is after 3-4 years of the factory operations, when the depreciation of income tax is less and the corporate tax depreciation will be more. But at the same time, if we invest in that year a substantial sum of money, the MAT will remain a problem in the near future.
Okay, understood.
The accounting answer, let me just tell you from an operational perspective, since we now have a couple of step-down subsidiaries and a large part of the new investment is happening in HFL Consumer, we are hopeful that we will start seeing some amount of MAT utilization in Hindustan Foods, the holding and the listed company, sooner rather than later.
Okay. And also you mentioned about the 10 crore invested for knitted shoes. Could you just talk about the potential, and would the top line be similar to the rest of the business, the asset terms, or how could you just throw some light on that?
So the asset terms in case of the leather business are higher. As you can imagine, leather business is predominantly a labor-intensive business. So frankly, the capex involved is very, very low. We are quite bullish about that sector, though we've actually not invested too much money in it. The current, or not, actually I can't even say current, in the last few months the government has taken certain steps which makes manufacturing of shoes, especially knitted shoes and sports shoes, better in India as opposed to importing them from China. So as a result, we are confident that we should be able to grow that business. However, I don't think you can apply the same yardstick in terms of asset turns, margins, etc., to that business like you do for our other businesses.
Got it. That's it from my side. Thank you so much for answering all my questions, and all the best for the rest of the year. Thank you so much.
Thank you. The next question is from the line of Anand Trivedi from Nippon Capital. Please go ahead.
Hey Samir, how are you?
Very good. How are you doing?
Good. Congratulations for media guidance, something that very few companies are doing in today's tough environment.
Thank you, Anand.
A lot of my questions have been answered, but just for more clarity, I'm looking at your presentation on page 3. You have this 4,000 crores revenue target by 25, and I just want to understand that is your current gross block is 550 crores. So this 4,000 is there assumption of a particular gross block?
So Anand, we have announced a bunch of things, right? So in fact, we took the in the previous call. What we've done is we've taken through the analysts with our journey from 2,000 to 3,000. And in terms of the gross block additions, yes, there will be some gross block additions. The 550 crores currently includes the capital work in progress of ice cream, but then we've announced a couple of more things. We've announced the bar project, but actually we've been talking about the bar project for a few quarters now, but we are hoping that we'll be able to start work on it next month. We've also announced an increase of around 75 crores of capex in the ice cream factory, and we've also announced some small capex in the Coimbatore factory, relatively doubling of capacity at ATC Beverages, and a small capex in the shoe factory. All of this, given the current visibility, we think will take us to our target of 4,000 crores.
Okay, so and then going back to what you earlier clarified, that so there's no additional equity going to be required to reach 4,000.
Okay, so Anand, let me rephrase what I said, right? So what I said is that all the projects which have been announced and which are in the public domain will be funded through internal accruals and debt. However, we continue to have a very robust pipeline, and I'll just take a minute to talk about this. Given the stress in the FMCG market, etc., we believe that there will be more opportunities coming our way, primarily because as FMCG companies grapple with growth as well as inflationary pressures, we think a lot more will start looking at contract manufacturing. We also believe that a lot of our principals will look at divestments where they want to get out of manufacturing, sell physical assets to somebody like us. We also are confident that we'll see some opportunities for consolidation where smaller contract manufacturers will probably not be able to cope with the volatility as far as the overall market is concerned. And these things we believe will give us a growth momentum for the next few years. Now, obviously this pipeline, and as you can imagine, any of these decisions have a gestation period of nearly a year. So this pipeline is robust and continuing. So just to recap what I said, for everything that we have announced, we do not need any more equity. We will be able to fund it through debt and internal accruals. However, whatever is in the pipeline, as and when it is announced, we'll obviously come back to you and let you know what's happening.
Yeah, and just to clarify, so everything you announced takes you to 4,000 crores?
Everything that we announce will take us to 4,000 crores by FY25. The pipeline might ensure that it might take us a little earlier, in which case the timelines will change.
Okay. And within this 4,000 crores, will private label be meaningful at all, or is it still small business?
I think it will continue to be a small business, Anand.
Okay.
I mean, as a percentage of turnover, it will continue to be small business. In absolute terms, it obviously will become far more meaningful than it is today.
Right. And one last question from me, which one of the earlier participants had asked, on your cash generation. And just to clarify this, so based on the loans that you had given, the auditor said that that should be part of working capital. If that was not the case, would that have been part of the net cash from investing?
Net cash from financing, no? Investing. Okay, sorry.
Net cash from, yes.
Okay, so
yes, it would have gone if it is treated as a long term, it would have gone in the net cash flow from investing.
Okay, so it will just be a reclassification, I guess.
Okay.
Okay, thanks a lot. That's it from me. Thanks, Amir.
Thank you. Participants, to ask a question, you may press star and 1. The next question is from the line of Vinod Malviya from Union Mutual Fund. Please go ahead.
Yeah, hi. Good afternoon. I just had one question. This was regarding your ROCE of your company. I just wanted to know that, if I just annualize the fourth quarter numbers, based on the fourth quarter EBIT numbers, and, given the net block or the gross block, what you have on the balance sheet and the working capital, the ROCE comes to around 15 to 16% compared to, 18-19% what you have been doing. I just wanted to get a, some understanding from you. Was there any one-off in this particular quarter on the margin side which led to lower ROCE, or was it like some capitalization happened on the balance sheet, but the corresponding income was not reported in the P&L, and that's why in this particular quarter the ROCE has come down?
So, Vinod, as you can imagine, ROCE would be on the basis of the capex. A large part of the capex which was made in Hindustan Consumer, the step-down subsidiary for ice cream, we started trial productions in the month of March, and the commercial dispatches have happened only in the month of April. I think that asset will start generating revenues and profits from, let's say, the next quarter or this quarter. And as a result, our ROCE at any given point of time, and I think Mayank referred to it in his opening remarks as well, that our ROCE at any given point of time would not be what we would like it to be, because we will have a substantial amount of money invested as capital work in progress. And given that we have certain aggressive plans in terms of growth, I think at least for the next few years, we don't see a steady state capex amount coming in to give you the ROC that we expect.
Okay.
So, your question, or do you want some more specifics? Then Mayank can give you those.
Yeah, just slightly more specific on the once your capex, heavy aggressive capex which you're planning to do, that's over. What kind of an ROC one should build in?
So it's difficult to give you an exact number. We'll give you a range in terms of ROE. Our expectation is between 18 to 22%. That's our expectation for return on equity. And in case of, okay, sorry, I'm getting too many prompts here. Just one second, hang on. I'm going to let Mayank answer this.
So as I told you that, as Samir told you, the ROE expectation is 18 to 22% and ROC expectation is between 16 to 20% on a steady state.
On a steady state. And just one more clarification. So this Hindustan consumer investment which you talked about, which has gone in the fourth quarter, how much was the capitalization done for that particular expansion?
Capitalization will actually be done in this quarter because we just did trial production in the previous quarter and the first dispatch happened in the middle of April.
The entire investment was in capital work in progress, Vinod.
Okay. How much was that number? Sorry. Only related to that particular project.
It was around 70 odd crores.
Oh, thank you. That's all from me. Thank you.
Thank you. The next question is from the line of Vishal Jain from Jain Capital. Please go ahead.
Yeah, good afternoon. Just wanted to understand a bit more on the capex in the health and wellness segment. That's about 100 crores. So what would be the product that would be manufactured in the particular segment, and is the capex limited to only one pharma plant or they are multiple?
Ashay, we've discussed this earlier. What we are doing with that 100 crores is we are actually acquiring a facility from Reckitt Benckiser Scholl. We've actually entered into a share purchase agreement already. This particular factory, which is located in Sri Perambatoor, Chennai, manufactures medical bandages and other foot care products. These medical bandages are also used for corns, blisters, etc., which happen on your feet. This facility is a manufacturing facility supplying, it's a MHRA approved facility supplying to close to 20 countries in Europe. And we expect to continue that business in that facility with the existing team as soon as we take it over, which, like Mayank mentioned, should happen in the next quarter. Having said that, that's not the only pharma business that we are looking at. Like I discussed with Anand earlier, we continue to have a robust pipeline in terms of acquisition opportunities as well as greenfield and brownfield expansion. As and when things happen, we will definitely come back to you and let you know what's happening.
Sure, that's all for us. Thank you.
Thank you. The next question is from the line of Amit Shah from ACE Securities. Please go ahead.
So, hi, sir. Sir, I just wanted to understand what are the risks that we see or we face in terms of not achieving our target of 4,000 crore revenue in next 3 years?
Amit, that's a difficult question, yeah. I mean, if I say something like we don't expect any risk, it's going to be hubris, and I'm sure it's going to get jinxed. So let me tell you this way, right? In case of our business, the basic risk is that about execution. If we are not able to execute a project in time or properly, or if we are not able to manufacture a product in the right quality at the right time, etc., our entire business is at risk because that's what we do, right? We only manufacture products for customers, and we don't do anything else. In terms of risk, we don't see macroeconomic conditions as a risk. We believe that in spite of the slowdown in FMCG, we think contract manufacturing will continue to grow disproportionately. And within the contract manufacturing space, given the diversification we have in terms of product categories as well as customers, we don't see demand evaporating as a risk. We believe that demand for our services will continue to be strong between the 2,000 to 4,000 crore journey that we mapped out. We believe execution, given the current team and given the additions to the current team that we are continually making, we think we should be able to address that risk as well. But then, of course, I can't talk about any external shocks that can come in.
Understood, sir. Thank you, sir. All the best.
Thank you. The next question is from the line of Harsha from InCred Capital. Please go ahead.
Hey, hi, Samir and team. Thanks for taking my question. So, given the nature of our business, which is more capital expensive and having thin margins, at what size or at what level of sales do you expect to generate free cash flow on a sustainable basis?
Okay, Harsh. Hi. Couple of comments first, and then I'll answer your question. One is, yes, we are a high capex intensive business with low margins, but I have to point out that that's by design and not by default, right? Given the nature of our business, we are guaranteed of those margins. We are guaranteed of that profit or EBITDA, and as a result, we invest into capex. So the correct metric for us is not to look at the margins. They will continue to be, all contract manufacturers by definition have to work at lower margins. However, the difference is in case of a company like HFL, we have the added comfort of the fact that we have long-term contracts which guarantee our revenues as well as which guarantee our EBITDA for the next 5, 7, 10 years. And as a result, we are quite comfortable taking on the risk of investing in capex in spite of the fact that the margins as a percentage of sales are low. So that's part one. As far as free cash flows is concerned, like I've taken pains to explain, we have an appetite to grow. We believe that contract manufacturing as an industry will grow substantially in the next few years. I don't see us resting on our laurels anytime soon. So we will continue to invest very, very aggressively in new projects, new categories, new factories, etc., at least for the next 3 to 4 years.
Okay. So I was not trying to argue on the low margins. I get that point, Samir, of the low margins, but I was just trying to understand that, let's say at 4,000 crores, which we have a target of FY25. Going ahead, assuming that the margins keep on increasing steadily, after that, do we kind of see a point where kind of we are generating free cash flow? And despite investing, I completely agree with your point that there are tailwinds for this industry, but despite investing higher, can we kind of expect free cash flow on a sustainable basis from FY25-26 onwards once we achieve a particular level of sales?
So if you're looking at free cash flows from an operational perspective, we achieve free cash flows from operational perspective within 3 to 4 months of a factory ramping up, right? If you're looking at
I'm looking at free cash flows, company's perspective net of capex,
So if you're looking at free cash flows from a company's perspective, where you're looking at declaring dividends or something like that, given that we think we have an opportunity to invest this free cash flow continuously at an ROE of between 18 to 22%, we believe that as a shareholder, any shareholder would be happier if we continue to invest that free cash flow into productive assets rather than return the money in a tax ineffective way back to the shareholders.
Okay, thanks for that.
If we continue to see investment opportunities and the growth, we will keep investing. The day we see that drying up, we'll come back and write a check to all the shareholders.
Okay, thank you for the answer. And one more thing, Samir, in our previous conversations, you did talk about, since we have a lot of dedicated manufacturing facilities, you did talk about that the scrap value of the factory at the end of the contract period is the joker in the pack, right? Where we can kind of fetch a higher value for that. So has there been an instance actually, basically where we have really seen that pan out for us, where kind of we've been able to fetch, a higher price for that factory? Because I remember that you shared that, you work on a particular ROE formula with your partners wherein you decide on a particular scrap value at the beginning of the contract, and whatever gains you accrue towards the end is something which belongs to HFL. So I just wanted to understand, has there been an instance of that occurring for us?
So Harsh, in terms of paper profits, absolutely. One of the largest factories that we have, where we have acquired some 20 odd acres of land. When we started acquiring the land, the cost was around 16 lakh rupees an acre, and the latest rate there is around 3 crore rupees an acre. So paper profits on that aspect of our business are there. Have we actually converted them into free cash or converted them into profit? The answer is no, because we've not had an opportunity yet where a customer has actually walked away from a factory or shut down the factory. But on the paper, absolutely, we see that across all our factories where land prices have gone up substantially, where the cost, I mean, just pure inflation, right? A building which cost X amount of rupees to be built 5 years ago, just by sheer inflation, the cost of steel, cement, etc., the salvage value or the replacement value of the building is much higher now. But all of this is in the paper, Harsh, so nothing to talk about.
Okay. Thank you. Thank you so much, Pete.
Yeah, thanks.
Thank you. Before we take the next question, reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Nikhil from Perpetual Investment Advisors. Please go ahead.
Yeah. Hi, Samir and team. Congrats on a great set. Most of my questions are answered. I just had some which one. So when you announce a capex, does it include the working capital investment, or is it only the fixed part?
So Nikhil, we generally do not announce the working capital investment, but in most of the cases, our working capital investment is minimal because that's the way the business model is. Having said that, as the size of the company grows, even that minimal amount is becoming large. But to answer your question, no. When we announce a capex, it's only the project capex. We don't look at working capital that time.
Okay, noted. And so I think it was Q1 or Q2 press release of last year where you had mentioned about pet foods and confectioneries, savories and deodorants as new categories, or probably you are exploring them. Any progress on them? I hear pet food is completely imported or majority is imported. So any progress in that?
So Nikhil, yes, I've taken pet food as an example. And while we are in discussion with a few people as far as pet food is concerned, I'm not at a liberty to discuss any specifics. But let me tell you that the industry dynamics that we talked about nearly 6 months ago are the same. Some of the pet food continues to be imported into the country, and a lot of awareness about pet food has increased. So we are now in touch not only with the established players as far as pet food is concerned, but we are also working with a lot of D2C companies who are launching pet food. So pet food as a category is seeing a lot of action, but I don't have anything tangible to report to you.
Okay. And any progress on the outsourced R&D business that of course you didn't say you wanted to start it, but you wanted to get into it eventually. Any progress on that?
So we have actually added to our team of R&D. We've set up a small lab. We've recruited some people. We've started doing some work. We've actually also, not that I'm proud of, but we've actually also developed a wasabi hummus, which we have launched in the market for one of our customers. So yes, we continue to do some amount of R&D, and our efforts along that are increasing.
I'll try to find the wasabi hummus in the market. Thank you for that. And one last question is, do you see demand for exports now? I mean, currently we are probably majority catering to the domestic market via your clients. Do you see a big export opportunity, or let's say, how is the flow of queries around exports?
So, Nikhil, actually export is a very interesting part. There's a lot of inquiries coming in, and I've talked about this separately in some fora, that we do not, FMCG does not have the infrastructure to be able to cater to all the demand which is coming out of China. Just yesterday, Sanjay, my colleague, and I were at a meeting with a American company who was just making a brief stopover in India, and I was shocked to know that just makeup brushes is a $75 million business for that company. All of it being sourced from China, and they are looking at plans of getting some part of that business into India. So I think the potential is huge. I think it's still going to take some time. We've acquired AeroCare, which is a color cosmetics makeup company. We are trying to build capabilities across these product categories. But for exports to become significant for us, I think it's still going to take some time.
Okay, no problem. All the best.
Thank you, Nikhil.
Thank you. The next question is from the line of Sumit Poddar from Tikona Capital. Please go ahead.
Hi, congratulations on great set of numbers. Thanks for the opportunity. I was referring to your presentation, while on slide 24 regarding different business models that we have. So could you throw some more light on how the bucket or the revenues will be divided between these three business models? And going forward, guidance on that 2,000 crores, how do we look at for that 2,000 crores within these three buckets?
Sumit, first of all, thank you. You're the first person who's actually congratulated us on the numbers. We all are very proud of the fact that we hit 2,000 crores and nobody seems to have noticed it. So thank you for that.
So that's the bad part of markets, that once you have already shared something, it always gets priced in. So that's the bad part of market. And
Samir bhai saying that once you made the announcement you achieved, they have forgotten us. But so thank you, Sumit. Now, to answer your question, yes, and for the benefit of everybody else on the call, I'll just quickly go through three business models. The three business models that we have are dedicated manufacturing. In this case, we set up factories for a customer, which basically is built to suit, which means it's a specific requirement of a customer. We build a factory around that requirement. The customer actually gives us a take-or-pay contract, which is for a long period of time, could be 5 years, 7 years, or 10 years. In this take-or-pay, all the costs, the operational costs are a pass-through, and what is guaranteed to us is a return on investment. 80 to 85% of our business is currently this arrangement, which is the dedicated manufacturing. The second part of that business, or the second model that we have, is shared manufacturing. In case of shared manufacturing, we are able to manufacture for competing brands or for competing companies, and none of these companies give us any kind of commitment. And if I can take a second, I'll just very quickly tell you how the transition works for us. As a company, what we like to do is we like to reduce the risk as much as possible, and as a result, we prefer dedicated manufacturing. While we are happy to take on shared manufacturing, we constantly nudge or push our customers to move towards dedicated manufacturing. And like we discussed about ATC Beverages, we've been able to successfully do that. ATC Beverages was when we acquired a shared manufacturing facility. It actually ended up making losses for us for 2 years because of the fact that there were no commitments from any customers. We've now, in these 2 years, successfully converted that into an anchor tenant dedicated manufacturing, where Hector as well as Tata Consumer have committed to certain dedicated volumes. So that's the natural evolution as far as business for us is concerned. I would say around 10 to 15% of our business is shared manufacturing, and a very, very small part of the business is private label, which is our third business model, where we basically develop products for D2C companies, we develop products for retail chains, etc. This business, I believe, will see some interesting times in the next few years, few months, and we'll see how that grows. Like I was telling Anand, while the amount will become interesting, as a percentage of the turnover, it will continue to remain small.
Sure. And how are the kind of ROEs or maybe ROCs in this business as such? I mean, which would be the best one as such?
So It's got to do with risk, right? So return would be completely commensurate with the risk. In case of the first one, which is dedicated manufacturing, we don't take on too much risk. We don't take on the risk of inflation. We don't take the risk of slowdowns. We don't take the risk of wars. So as a result, we are happy to do a business between ROE expectation of 18 to 20. Right? In case of the shared manufacturing, we take on a lot more risk, and as a result, our ROE expectations are higher. And in case of private label, we take on even higher risk, and as a result, our ROE expectations are even further higher there.
So what kind of investments then we are putting on the private label manufacturing side? And as you mentioned, it will continue to be a very low or similar proportion of our revenues. I mean, the question I asked is primarily because how do you then add value or incremental differentiation to your business is more my questions.
So in case of private label, actually you don't require investment in plant and machinery, right? Because the private labels actually will piggyback on our shared facilities. And as far as the capital allocation policy that the board has set up for the company, in case of shared manufacturing facilities, we've been given the leeway to invest up to 30 crores of rupees. And if it's anything beyond that, we necessarily require some kind of an arrangement with our customer, either by way of buyback or a long-term commitment. In case of private label, I think the investment is more about R&D. The investment is more about vendor development. The investment is more about our network of using larger vendors, which we are working with for our multinational companies, etc., and trying to get them to service smaller brands. I think that's the value addition we bring in for private labels, right? So, for example, if a small company which is manufacturing, let's say, a toilet cleaner, they would not be able to get access to the same kind of resources that the market-leading multinational company manufacturing toilet cleaner does. We are able to bridge that gap and bring them to an even keel, at least as far as operations and vendor development and quality is concerned.
Sure. And of course, my question was more on the R&D or talent side, as you shared already. I mean, but with the current D2C kind of boom that is going on within the FMCG space, how does this concept fit in as such? Is what my question was.
So it's very interesting, and we are actually also watching it with a lot of interest. I think the D2C boom is definitely there in terms of funding. I think the D2C boom is definitely there in terms of the media coverage. I think we are yet to see the D2C boom actually reflect on the retail shelf. It's early days. I think all of these guys are doing some great job. Some of the larger companies are doing a fantastic job in terms of new ways of attracting customers, etc. I think the next couple of years will actually show what will happen in terms of these D2C brands. It's very interesting, and that's one of the reasons why we've actually developed this particular division in our company. That's the reason why we are investing in R&D, etc. As you can imagine, you don't expect a Reckitt Benckiser or a Unilever to approach us for R&D. The R&D setup that we are doing or the smaller facilities that we are setting up is essentially for these kind of companies.
Sure. So largely, I mean, that 5% revenues would largely be D2C guys, or it is a mix? I mean, or rather, I mean, how much percentage would be the new age guys in your revenues?
It's very, very small, yeah. I mean, Sumit, right now, I mean, I keep referring to this, and at some point of time, Mr. Sanjeev Mehta is going to be very unhappy about it. But he said it in one of the interviews, and I just keep repeating the same dialogue. He said that Unilever is a 50,000 crore company, and it grows at 10% every year. So which means they add around 5,000 crores of turnover every year, whether it's by volume or whether it's by value. All the D2C companies put together do not have that kind of a turnover, right? So as a person, I mean, I'm talking about just the incremental turnover, that's 5,000 crores. So as a result, from a turnover perspective, I think D2C companies will continue to be very, very small. But strategically, I think you're seeing a shift in FMCG consumption, and you'll see this shaping up in the next few years.
Sure. Got it. I'm just referring to the questions regarding FCF that was being asked earlier. So while I understand that a growing business will always need capex, and it is always prudent to invest in capex first, because that's, I mean, a business growing at 50%, 70% kind of CAGR would need continuous capex per se. But then, what are the areas that can really help you to generate much higher FCF, which actually takes care of your capex as well as much more value adding? Because if actually capex slows down, which ultimately means that you are not seeing much of a growth of the rate of growth that was being seen earlier. So, and particularly given the opportunity that you have, you'll have to have continuous capex. So how do you really solve this mystery as such?
So I think that's an excellent question, Sumit. So here's how it's going to pan out, right? I think in our dedicated manufacturing, we do not get any operating leverage on our capex. So whatever money we invest is directly proportional, or rather whatever money we make will be directly proportional to the investment, and as a result, the more we invest, the more money we'll make. However, there are two aspects or two windfall gains or alphas in the term of anybody who is sitting here and prompting me. The alphas will come in from a couple of things, right? So in case of dedicated manufacturing, we only play on the financial leverage. We do not play on operating leverage. In case of shared manufacturing, on the other hand, there is a lot of operating leverage. We believe that in the next 4 to 5 years, as a larger percentage of our business moves out of the dedicated manufacturing and converts into shared manufacturing, we will see some amount of operating leverage coming into it. And that operating leverage will hopefully give a lift to the ROE that we can drive from that particular investment. And I think that's going to be a very important part. And then the third part, of course, is the private label. The private label, assuming that they grow, we are very confident that we don't see private label companies or D2C companies, or for that matter, retail companies investing in manufacturing assets, which means they'll continue to come to contract manufacturers like us. And we believe that we'll be able to sweat our assets much better with those guys as compared to the larger multinationals. And the last thing, which I briefly talked about, and someone talked about it as well, which is export. We currently are not considering export as a part of our portfolio because of certain infrastructural gaps. But I think in the next 3 to 4 years, we'll definitely see that happening. And I think that should unlock some amount of alpha as well.
Got it. Thank you so much for the insightful answers. I wish you all the best. Thanks.
Thank you so much.
Thank you. The next question is from the line of Akhil Parekh from Centrum Broking. Please go ahead.
Hi, Samir and team. Once again, congratulations on achieving...
Sorry to interrupt you, Mr. Akhil, but we cannot hear you, sir. Can you please speak a little louder?
Sure. Is it better now?
Yes, please go ahead.
Yeah. Hi, Samir and team. Congratulations on achieving the target of 2,000 crore. My first question is on the beverages part and the ice cream unit. Given that these products are seasonal and the capacities are not utilized for the entire year, do the ROCs differ meaningfully as compared to the other products, and will we see a dilution in ROCs with the incremental capacity utilization for the beverages and the ice cream plant?
Thank you, Akhil. No, the short answer is no. Our ROCs are guaranteed for the year, and as a result, they take care of any seasonality which might come in within the year. Yeah, I mean, to answer that question very simply, we look at it at a yearly basis.
Got it.
And you will see some amount of difference from quarter to quarter. On an year-end basis, it evens out.
Yeah, got it. And the asset turn also is broadly similar, basically, for this unit?
So the asset terms actually depends on the product category, and you've talked about ice creams on one hand, and you've talked about beverages, both of them completely different product categories. Even within the product category, it depends on what kind of SKUs we make. For example, if you're making the lower MRP products, the 5 rupee, 10 rupee products in that factory, our asset terms would probably be lower. So as a result, it's very difficult to give you a specific comment on whether ice creams will have better asset terms or not. What we do is general indication is, in our experience, we believe that we should be able to get a 3 times asset turn on most of our product categories. Some will be more, some will be less.
Oh, got it. Second thing is regarding the Shoal India investment. We have mentioned that we'll see 100 crore of top line in FY23, but the legalities or the formalities will only be done by end of first Q23. So the contribution from this business will only be for the 9 months, right? So it won't be completely 100 crore in FY23. Is that interpretation correct?
Absolutely correct. In fact, the legal implementation of that deal is already delayed. We were hoping that we would have been able to get a full year in as far as that facility is concerned. Unfortunately, that's not happened. So you're absolutely right. Every day that we are not able to close the deal, we lose turnover as well as profitability.
Got it. And last question on the dedicated units. We have a model where we get assured volumes for the particular product which we are manufacturing from that unit, right? But say, for example, tomorrow if the macro situation turns bad for XYZ reason, will we still continue to see those kind of assured volumes? If I were to give an example, right, the edible oil prices have moved up, say, have doubled over last 1 year, and all of a sudden if we see a reduced offtake by the consumer, does that hurt our volume assumption as well as the dedicated unit?
So, Akhil, the short answer is no. We have the arrangements are that we are agnostic as far as volumes are concerned. Of course, this does not envisage a complete shock basis, but let me just give you an example of even in the case of COVID. If you look at our results during the peak of COVID, most of our customers stood by us and were okay with the underutilization of the factories. So the short answer is that no, the volumes, the changes in the volumes is not a risk that we carry on our books. It's a risk that is carried by our principals.
Got it. And last, from my side, the bar project has been delayed. So is it from the client side or is it from our end?
The client side, for sure.
Okay. All right. Thanks a lot and best wishes for coming call.
Thank you.
Thank you. Ladies and gentlemen, this was the last question for today. I would now like to hand the conference over to Mr. Vimal Solanki, Head Emerging Businesses and Corporate Communications, for closing comments.
Thank you, Rituja. Overall operational and financial performance for this year has been in line with the company's targets, and we are on track to meet our medium-term and our long-term goals. We continue to believe that there is enormous untapped opportunity in FMCG contract manufacturing space, and we remain focused on accelerating growth through our strong capex plans and capturing the large pie of this opportunity. With the new acquisitions and organic growth from our existing factories, we are confident of achieving the target of 4,000 crores of turnover by FY25. I take this opportunity to thank everyone for joining on this call. I hope we have been able to address all your queries. For any further information, kindly get in touch with us or SGA, that is Strategic Growth Advisors, our investor relations advisors. Stay healthy, stay safe. Thank you so much.
Thank you. On behalf of Hindustan Foods Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.